Partners, Miss Emily Ho from the Port of Seattle.
Thanks, Miriam. Yeah, hi everyone. Erin, Abdul, you were on here last time. Um, but I'm Emily Ho. I am the Engagement and Training Program Manager at the Port of Seattle. We're very pleased to be working with Apex Accelerators and to have Kara here again, back from last week talking about advanced bonding. I don't think we've offered this through our Apex, through our advanced PortGen. So I'm really excited to hear more about bonding from Kara. And yeah, we scratched the surface last time and we're ready to go deeper. So yeah, thanks everybody for being here.
Absolutely. And so as we go, Cara has requested that if you all have questions as you go, feel free to raise your hand and ask her as we're going. The goal is to be a conversation more so than her just kind of spitting things at you. So we want this to be interactive, and you three are here and engaged. So if you have questions as we go, again, just throw your hand up so we can recognize you. So that way your questions are pertinent to what she's talking about. And then we'll go from there. And our goal will be to get through this information and try to save a few minutes at the end, just in case if you have another question that comes up. So with that in mind, Cara, please take it away.
Thank you. I really appreciate the opportunity to do this. Like you said, I don't get to do as many advanced classes. So this is one that I don't do very often, and I'm really excited to do it. And every class I teach is better than the last class I taught. So this class, you guys, is going to be the best class I've ever taught. All right, let's make sure that our screens are working. There we go, advanced bonding strategies. I'm not going to introduce myself too much because I did last time already, but if you forgot and you want to know more about my history, I'm third generation surety bond professional. And if you go to thebonder.com, I talk a little bit about my grandfather and how he got in the business, my father and how he got in the business, and so forth. So they're actually really entertaining stories and not the traditional boring stories. Today's agenda, I just want to quickly review, and I bet you guys already know this, but quickly review the last class. You need to know at least the three parties to the surety bond contract, or you need to know who the principal, the surety, and the obligee are. Are your three main bonds. We're going to talk about some other bonds, but the three main bonds that probably touch your life more than any other are going to be the bid bonds, performance bonds, and payment bonds. So you need to have a general understanding of that. And then the three C's, and this is underwriting. And I think we were joking last time that every industry seems to have their set of C's. Sometimes it's three or four or five. But this is going to be important because we're going to touch on these quite a bit, the character, capacity, and capital. Today's goals, we're gonna look at financial statements, and I promise I'm gonna try and make it interesting. I think it's really cool. I never wanted to do taxes, but I do find the actual accounting super interesting. And if you are a business owner, this will really help you continue to be a great business owner. We're going to talk a little bit about ownership, a couple of misunderstood bonds, and then I was asked that this is what everybody wants. How do you lower your rate and how do you increase your bond program? So that's what we're going to end with today. So hopefully I'll be able to answer those questions for you. This was a slide that we had before, and I just want to touch on it again. We're going to do mini review. These are the items that are usually required for a surety bond program. Company financial statements, this is what we're going to work on today a little bit. We're not going to spend the whole class on this. Finding an experienced construction CPA, an experienced construction bookkeeper or accountant. And I'm saying this for a reason, and you're going to learn why. It's construction, the business is already complicated, but the accounting for construction is really complicated. So finding somebody that understands your business is going to be really important. And same with finding a banker. You want a banker that understands your business. You want an attorney that understands your business. You want an insurance agent that understands your business because it is really, really unique. Okay, are we ready? Do we have our pencils ready? We're going to start working on financial statements. These are the documents that are required to make a financial statement. It's not just the balance sheet. It's not just the income statement. It requires all of these things. So when someone asks the bank or your surety professional says, I need financial statements, these are the documents they're looking for. The balance sheet and the income statement are absolutely required. The opinion page is going to come from a CPA. So if you're preparing these yourself, you're not going to have that. The schedules of AR and AP, that is accounts receivable and accounts payable. That these documents are not just for the surety company. These documents are not just for your banker. I really want you to understand these documents so that they are a tool for you. And it's not just something you're like, oh my gosh, I have to get this to my surety. But I want you to be able to understand these so that it is a tool for you to run your business. So our two main documents that we're going to work on today are the balance sheet and the income statement. The balance sheet is a snapshot in time. It is a piece of paper or two pieces of paper that says where your business is at a particular time, what your business is worth right at that moment. The income statement, on the other hand, is a picture of a period of time. So you might get an income statement, also called a profit and loss or a P&L, over a period of time, right? So your income statement is going to be maybe from January 1 to December 31. And that's a picture of your business over time. Whereas the balance sheet, if you get a 12/31 2024 balance sheet, is just at that moment, because the balance sheet's going to have things like cash, and that changes probably throughout the day, right? So the balance sheet is a snapshot in time. The income statement is a report over time. Okay, we're going to talk about the quality of a financial statement. This is where things start to get a little bit complicated. So the quality of a financial statement is how the statement is prepared. Okay, in all of accounting, there are four main ways to account or to the quality of the financial statement. The first one is the in-house or internal. And basically that's just you going into your QuickBooks or your other accounting system and printing out your balance sheet and income statement or your profit and loss. The next three are prepared by a CPA. The CPA compilation is kind of what it says. The CPA takes your, let's say you print out your QuickBooks balance sheet and P&L, you give it to your CPA. They kind of look at it, make sure it balances, put a fancy cover on it, and charge you $5,000. It's a little bit more than that. I might be exaggerating a little bit, but they don't go into any great depth to review the numbers on the financial statements. The next level is a CPA review. This is the level where the CPA is going to actually review the numbers. So we touched on accounts receivable and accounts payable. So they might actually look at those accounts receivable, make sure that those accounts receivable are really money that you as a business owner are going to actually receive. So the CPA review is going to cost you a little bit more. I might be exaggerating on the $5,000 for a compilation, but depending on your CPA, it could be. Your first year working with a CPA will be more expensive than subsequent years because they're going to have to clean up the books. And I don't mean that they're a disaster when they get them, but they're going to have to make sure that they're accurate. And they're also on your first year, the CPA is going to go back a year because in order to make that snapshot for a balance sheet correct, and in order to make sure that that income statement is correct, they have to know that what they started with is correct. So they're going to go back a year for your first year with a CPA, make sure that year. So let's say that you're going to work with a CPA for the year 2025. You hire the CPA, they're going to go back to 2024, ask you a whole lot of questions, make sure that's correct, and then they're going to start working on 2025. And that will make it a more accurate financial statement for you. So that's the CPA review. This is what the surety companies really like to see. If you're not doing really large bonds and you're not looking for a very large program, your internal financial statements might be enough. Um, if, however, you don't have really clean financial statements or you don't have someone in-house actively working on the financial statements, this might be the next step. Oops, don't look at that. This might be the next step. But this, if you're doing jobs, single jobs over 1 million, that's usually where they like to start with a review. A lot of times, if we have really strong internal financial statements or a compilation, sometimes we can get away with a lower quality level financial statement until you start doing jobs in the 3 to 5 million single job. However, I would say start to get to know a CPA early. If you haven't, even if you're doing $1 million jobs or jobs under 1 million, you might need a CPA to do your taxes, and you might as well get a really strong CPA. And if you're planning to grow, hopefully that CPA can grow with you if they're a strong construction CPA. The CPA audit, this is very expensive. I think there are only 3 CPAs in the United States that actually will do an audit. You're not going to need an audit until you're doing 40, 50 million in revenue a year. And a lot of times we can get away with a really, really good review because I don't even know how much that audit is. If our compilation's 5,000, the review could be 10,000. Could be, if you're working with a very fancy CPA, it could be more than that, especially your first year. And I hope I'm not freaking you out. This is the cost of doing business, and I'm going to show you where you're going to be able to recoup those funds. Okay, so that's the quality. Yes, Maryam.
I have a question as you're talking about, there's very obviously the harder it gets or the higher it gets, the less companies that do it. You mentioned
Right.
only 3 for the audit. If somebody was looking to try and shop around to find a CPA to do that review, do you
Yes.
have a recommendation of
I
someplace
have
they
a
can
list.
look?
Yep, I have a list of CPAs that are good, that understand the construction business. You're going to find a whole lot more that do reviews than do audits. But a lot of, so this is a big, doing a CPA review is a big liability for the CPA. The CPA, remember I said that there's an opinion page? That opinion page is their liability because we as a surety or the bank can come back to that CPA and say, hey, you screwed up this financial statement, and we relied on the financial statement to loan money to your client, these clients, right? So you've probably heard things in the news. There are a lot of changes that have happened over the last 10 or 20 years. There were some CPAs that were doing some audits that got in some big trouble because they were hiding some things. I won't name names. You guys can probably guess what that is. There are a lot more CPAs that do reviews. However, you really do want, I mean, a construction CPA doing your review, especially if you're going to pay that much. You want a really strong CPA to do that. Really good question. I appreciate that. And if anyone's looking for some CPAs, I can send you a list of CPAs I'm assuming in Washington. I'm assuming everybody here is from Washington. And I can do some research outside of Washington too. Any other questions on the quality, how it's prepared?
No, and Leslie was kind enough to put a link in the chat for Washington State Certified Public Accountants as well. So,
Perfect. Awesome.
yeah.
I
I
have
appreciate that.
one follow-on question.
Sure.
I mean, you're saying it's important to find a good construction CPA. If I'm shopping around, how can I tell if somebody is good, if a CPA is good or
Yeah.
isn't?
So a couple of things. One, um, ask for a reference. Talk to your banker, talk to your surety professional. If you have an attorney that you work with, maybe talk to them. Make sure that they really understand construction. They probably will have a construction arm. Like a lot of CPAs will actually have a group of CPAs that just do construction because it is that unique. Another thing I think is important is meeting with them, and you have to feel like you have. I mean, they're not managing, but they're keeping track of your dollars, right? And you have to trust them. So I would say interview them, and they're used to that. I've had when I was interviewing for a CPA, I interviewed them. They came to my office and told me, how great they were. And if you need to feel comfortable with who your CPA is, you need to trust them. So I definitely do at least those two things. Awesome questions. I really appreciate that. Thank you. Okay, now we're going to talk about the method of accounting. So this is totally different. This is how you count your money. So we're gonna go deeper into this, but the basic method is cash basis of accounting. Almost everybody starting in business and every CPA that does taxes is going to say you want to do your accounting on cash basis of accounting. What this means is you are only counting the dollars that you have actually received and the dollars that you have actually spent. So this means when you're on a construction project, you've done a certain amount of work. You know that you have asked for because you've sent out invoices. So money is going to come in, but you're not counting any of those dollars. When you hire subcontractors and suppliers, you may not pay them right away, but you know that you're going to have to pay them. So for cash basis of accounting, we're not counting any of those dollars that you haven't actually spent yet. So anything you've put on a credit card, you haven't actually spent yet, but you know you're going to. So this cash basis of accounting, this is how you want to file your taxes, right? And this is why most CPAs starting out that don't know anything about construction, especially, they're going to say you want cash basis of accounting. And for taxes, you do want cash basis of accounting. However, those reports are not useful to you as a business owner. They're not telling you where you're actually at, right? So we're going to talk about a couple of other things that will give you as a business owner more information to make better business decisions. You can file your taxes on a cash basis of accounting and have internal financial statements for yourself that are different than how you file your taxes. That's not double booking. Okay, so accrual basis of accounting is a more accurate picture of your business. Accrual basis of accounting will have those accounts receivable and accounts payable because these are dollars you haven't received yet, but you know you're going to, hopefully, depending on who you're working for, hopefully you're going to get it right away, or at least within the next 30 or 60 days, right? So this will be a better picture of your financial statements on the accrual basis of accounting. You're going to have accounts receivable and you're going to have accounts payable. So those things you've put on your credit card, those are going to go into that financial statement. That supplier that you ordered material from that you haven't paid just yet, that's going to go on the financial statement. So now you as a business owner, you have a better picture of where your business is at. And you can now make better business decisions because of that. The next one, okay, well, actually, the next two, these are unique to construction. There is no other industry that has 4 choices to count for your money. And this is what makes accounting for construction so complicated. The percentage of completion basis of accounting is pretty much what it says and is a complicated way to account for your money, but is the most accurate. So it is a step above this accrual. So we are taking into account accounts receivable and accounts payable, right? You've sent an invoice to the owner, that's put onto your financial statement. You have ordered material, that's put on your financial statement. However, as a construction company, right? You've done work for, let's say, 30 days, but you have not yet been able to invoice because there's a day when you're allowed to invoice. So you can't invoice until a certain day, right? But you've done 30 days worth of work, or let's just say 3 weeks worth of work, right? Where does that get measured? That's where this gets measured, in the percentage of completion. So if you're starting out and you're doing small, short-term projects, this is going to be overkill. However, when you're doing very large, very long-term projects, this percentage of completion basis of accounting is going to make a big difference. So I would say, since this is complicated, start doing it right now when it's easy. When you're doing short-term, smaller projects. It'll be simple to start learning this so that way when you're doing much larger, long-term jobs, and when I say long-term, I'm talking a year, 2 years, right? Now you're as a business owner, you're able to look at your financial statements and make decisions 6 months in, right? 7 months, 10 months, a year in, and not wait until the end of the job to find out that you've lost money. So this is going to be a lot more complicated. We're going to take into account the money that you're going to spend. You've got labor for 3 weeks, right? That you haven't been able to bill for because the date of that you're allowed to bill hasn't come up yet. But you want to have all of that in your financial statements. So that's what percentage of completion basis. Oh yeah, go ahead, Miriam.
So an example of that is as I'm listening to you
Yes.
say that would be um I'm looking at a project and at some point of it, I'm going to have to order certain things, but I have the opportunity to get them now. One, there's a lead time it takes to come in, and I don't want to wait until then, but
Hmm.
I am spending the money now
Hmm.
to get those materials so I'm
Hmm.
ready.
Hmm.
That's kind of where that
Yes.
could be
Well,
recorded there. Like,
absolutely.
okay.
It goes both ways. So let's say almost everyone, this isn't a secret, you're going to probably overbill a little bit with your mobilization, right? So you may bill for a lot of stuff early on for mobilization that you haven't done yet. So that information is also put on your percentage of completion because you haven't earned it yet, but it will eventually come. So you're accounting for that too. So you're going both ways. You're accounting for both of those things. Like I said, it's not an easy method of accounting. QuickBooks does not handle percentage of completion easily. There are ways to do it, and I'm happy to talk about it. I don't want to talk about financial statements too much because I don't want people to get like sick of accounting. Um, I think it's really interesting, but um, the last method of accounting we're not going to go into too much because I think is dumb. This is you're only accounting for the contracts you've completed. So why would you do that? Why would you only have a financial statement that only includes the projects that are already complete? Maybe for taxes, and that's it. There are some rules. I'm not a CPA. I can't remember what they are in order to do a completed contract method of accounting and file your taxes that way. Um, you're eventually going to pay them. You're just deferring taxes with the completed contract method. But there's no use for you as a business owner. There's no use for the banker or the surety professional to do a completed contract method of accounting. So we're just going to talk mostly about these three methods of accounting. Any thoughts or more questions on that? Okay. We're going to analyze some financial statements. Don't get scared. This will be fun. Okay. I promise. We're going to there are probably 100 different ratios that the surety company looks at, but these are the four most important. And these are the easiest ones for us to do in a class like this. So the first two are working capital and net worth. Both of those come from the balance sheet, right? That's our snapshot in time. Working capital is kind of what it says. It's what the surety company believes you have to work with based on a snapshot in time. So the working capital is total current assets, and I have some financial statements we're going to look at, so we can do that. But total current assets subtract total current liabilities, and whatever's left is what you have to work with. That's your working capital. Okay. Net worth, this is what your company is worth if all your assets were sold and all your liabilities were paid. What's left? Net worth. That's the net worth of the company. And then the revenue and net income. This is what most contractors know probably off the top of your head. So if I said, what was your revenue last year? That's your top line. That's the total amount of sales for the year. And if I say, what's your net income? What was your profit for the year? Most contractors know this. These are not ratios. You don't have to do any math for this. You just look at the financial statement to get those numbers. So that's why we're choosing these things. So this comes from the income statement. Working capital, we talked a little bit about this. These are the funds available for the business to use. And we'll go into that. I'm going to go a little bit fast over this stuff because I already talked about it a little bit, and you're going to get these slides. Net worth is what your company is worth, right? Sometimes you'll see it listed on the financial statement as owner's equity, partner's equity, depending on the what kind of organization you have. Revenue, that's the easy one. It's the top line, right? And then net income is the bottom line. And sometimes it's even called that bottom line. People kind of use that sometimes in other language, right? What's the bottom line? Okay, we're going to look at a financial statement. Okay, don't be scared. This will be fun. This is a cash basis financial statement. See, I put cash there, right? So I combined a balance sheet and the income statement into one form to make this simple for us. So this top part is the balance sheet. We have our assets over here. So we have cash, and then we have some equipment and so forth. And then on the liability side, we have our the notes payable for equipment and so forth. And then we have our net worth. And then down here, this is a very condensed statement of income or P&L or income statement. So we have revenue, that's our top line, right? And then we have our loss. This poor company lost money. So we have, this is current assets. We have 100,000 in current assets, right? Our current liabilities, if we subtract our current liabilities, right? Not long-term, but our current liabilities are only 5,000. So for working capital, we have 95,000. That's not bad, right? The surety company is looking for about 10% working capital to approve a single job. So if we have 95,000 in working capital, what size job do you think we can do? 900, right? 900,000? Because you, as a contractor, you don't need, let's say, you don't need $1 million to do $1 million job, right? But you do need enough to mob, and for the first, until you get your first draw, you need some money. You need working capital. So about 10% is what the surety company is looking for. So we could probably give these guys a little bit. Their net worth, this is the net worth. We just have to look at it here. A lot of times the surety companies are going to do a whole lot more to the financial statements. I'm making this super simple and stripping away a lot of stuff here. But in general, we're looking at net worth of 650. So that means that the company is worth $650,000. So that's good. We need to see a positive number there, a strong number there. Revenue is 6.5 million. That's pretty good. And they lost money. So I'm probably going to ask some questions. What happened? Right? This is our cash basis financial statement. This financial statement is an accrual-based financial statement. I'm going to show you some differences here. So on our financial statement we had before, we didn't have accounts receivable or retainage payable or retainage receivable. And this is all money that's coming in for you as a contractor and can add to your working capital. So for this financial statement on the accrual basis, our current assets are almost $2 million. Our current liabilities are $1.5 million. So now look at our working capital here for this company, 390. What do you think we can get for a single job for this company?
A lot more than the last one.
That's right. Our net worth here is almost $1 million, looking pretty good. Now our P&L, our income statement down here is we have 8 million in revenue, and this company made some money, so we're doing pretty good. Now our percentage of completion basis. This is the one that's a little bit more complicated. So we do have our accounts receivable. But we also have costs in excess of billing. So this is what it's going to cost you, but you haven't billed it yet, right? So for that time, for some of those large long-term jobs, this is the amount that they were able to, and there's a whole nother report, it's a whole nother class, but this is the amount that they were able to calculate to say, hey, we haven't billed this yet, but we know we're going to get it because we've already done the work. And then on the other side, on our liability side, we have all the regular stuff that we had before, right? But now we have billings in excess of costs. So this means we overbilled, which is okay. It makes sense to be able to overbill a little bit, right? Let's not get crazy. The owners are going to freak out. But we need to be able to overbill a little bit to kind of balance things out, especially if we know, and actually you had a really good Miriam, example, right? When you said that you know you're going to have to order something, right? And maybe you can't get billed for it yet. So this balances this out. So now you, as a business owner, you have a better picture of your business. You know it, pretty much exactly everything in construction, everything in life is an estimate. But this is a better picture, a more accurate picture of your business. So now for this company, current assets, we have 2.3, current liability is about 2 million. So our working capital is 300. So we're about the same as the last financial statement we looked at. The last one was a little bit more. But again, this is a more accurate picture of your company and where you're at. Net worth is 850. That's nice. Revenue is about 8 million, and it looks like we made some money. So we're doing good, right? All of these financial statements are the same contractor. Every one of them. So all three financial statements prepared differently give you a totally different program. This gives you a different surety program depending on what you present. Not only that, you're now looking at, depending, I mean, if you're looking at only cash basis, you're asking questions that you don't need to ask. Like, why am I losing money? Because you're not, right? You may think you have a little more working capital than you had if you're not working on a percentage of completion basis. So here's what we got. Cash basis, working capital is less, net worth is less, revenue is less, and you lost money. So this is what you do for your taxes. If I get this financial statement, I will not send it to the surety company. I'm going to come back to you and I'm going to say, let's work on at least getting accrual. At the very least, get accrual, because at least here we now have some working capital and you've made money. The company's worth a whole lot more. So I'm going to be able to get you a better program because of the way you prepared your financial statements. That's it. That's all this is. It's just the way you prepared your financial statements. Isn't that cool? Okay.
I imagine that's
Thank you.
why, like you said, you need somebody who's experienced in construction
In construction.
specifically, as
Thank
opposed to
you.
just a general
Yeah.
CPA to understand the nuance of this and why
Mhm.
it's important to be
Yes.
able to parse that out. Yeah.
Right. Even if your construction CPA is going to do accrual basis because maybe it's cheaper, maybe you're still starting out and you're still small, but then when you move up and you grow, they'll be ready and they'll have experience, you'll get to know them, and they'll be able to move to the percentage completion basis relatively easily. Okay, that's enough for financial statements. I think we took up a chunk of time. So I want to move on to some other things. Some other things. So remember we talked about there's three C's. So I basically killed the capital C. We talked a whole lot about capital. So let's talk about some of the other things. Ownership, super important to you as a business owner, as well as the surety company and all of your other partners. Continuity. I hate to talk about this with a new contractor, that like a new client, but this is really important and it can be really hard and really sad if you do not have a plan. So continuity basically means what happens if something happens to you, the business owner? Do you have a plan? Is it in writing? And I think I might have said this at some point in some class. If it's not in writing, it didn't happen. And things can get really wonky when you're under a lot of stress. And if something happened to you, there's going to be some serious stress happening. There is an agreement called a buy-sell agreement that you can actually fund. So you can have an agreement ready to go. So if something happens to you, you already have chosen somebody to buy it and you would be the one selling it. And then to fund it, there are insurance policies, life insurance, basically life insurance policies to say, hey, if something happens to me, I'm the business owner, I'm going to sell it to maybe my top person at the company. And that person might not have the money to buy it from my estate. So this insurance policy would cover that. Was there a little hand up or was somebody just moving? Um, so something else to talk to the surety company about is if you do change ownership, let's say that you have not passed away and you are retiring and you want to pass the company on to family or maybe some employees, or you just want to sell. Talk to the surety company early, because when you sell the company or buy a company, you're going to change your balance sheet, right? Remember that balance sheet is a snapshot in time. So you if you sell your company, now the balance sheet might have a liability on it for the sale of the company. Let's say you sell your company for $5 million. Dollars. I'm making it up, right? Now you have a liability on there for $5 million. Dollars. What is that going to do to your working capital? What's that going to do to your net worth?
Gonna decrease it.
It's going to decrease it a lot. So now what happens to your surety program? You just blew up your surety program. And now you have sold a company that can't get a bond. Okay, so we have ways of fixing this, but you have to come to us before you sell. I can't tell you how many times I get a year-end financial statement. I'm like, what happened? Oh, we sold. I'm like, holy crap. You can't do that without talking to us. Now you have no surety program. So come to the surety early, talk to an attorney, make sure you talk to your banker, come to us early for this. Some other things, oh, this is ownership changes and selling your company, basically the same thing. I was going to talk a little bit about ESOPs. You have to have I want to say either 50 or 100 employees in order to do an ESOP. And we're at quarter to 10, so I'm not going to go into ESOPs, but I will later if you really want me to, because I want to touch on a couple of different bonds. I told Emily on the first one, we were going to talk about retainage bonds. Retainage bonds can be really misunderstood, as well as developer bonds. And even if you're not a developer, I want you to understand where the surety is coming from on these. But let's talk about retainage bonds first, because that is, especially in Washington, lots of questions, really misunderstood. There is an RCW surrounding this. Basically, what a retainage bond is, it allows the owner or the GC to release funds early. This is not a required bond. So in your contract, you might have a requirement for a bid bond, performance bond, and payment bond. There is an option for retainage bonds. Retainage bonds are not required. This is a benefit, and not everybody qualifies. So even if you qualify for a performance and payment bond, you may not qualify for a retainage bond. The retainage bond is basically collateral to the owner in case something happens at the end of the job. If there is a problem on the job and the surety has to step in, that collateral, that retainage, belongs to the surety company. So not everybody can get a retainage bond. The larger, more sophisticated in contractors will probably have a program that they can, and eventually you'll get there if you're not there yet. Some of the things I wanted to, we had this hierarchy before, and this kind of gives you an idea of, this is just retainage bonds here, okay? We're gonna talk about the owner, the bond here. So we've got the port is our obligee, right? This is our retainage bond, and our general contractor is the principal. So the principal, when they sign the contract with the port, let's say it's a big job, it's a $10 million job, right? And that's a good chunk of retainage. So early on, our GC is going to say, hey, I want to post a retainage bond. The port's like, sure, that's fine. They don't get really excited about it probably, but they have to do it because we have an RCW. So this means that each draw that you get as a general contractor will not have that holdback, and you'll get 100%. So what does this help with? This is going to help with working capital, right? I mean, not even just on the financial statement, just you cash flow as a contractor, this is going to help you, right? Let's say that you've got a $10 million job and you're the GC and you hire 3 subcontractors. And the subcontractors are like, oh, well, we want to do that too. We want a retainage bonds as well. And let's say they actually qualify. Okay. Now our general contractor is the obligee on these three retainage bonds, right? And the subcontractors are the principal, and they do it early on. Here's the complicated part in the statute. The statute says that the general contractor can charge the subcontractor for their portion of the bond. Retainage bonds are not expensive, they're about 1%. So let's say the general contractor pays the 1% for their bond, and now our subcontractor is posting a bond. So this subcontractor has to pay 1% for their bond. But the general says, since I'm doing this, you have to pay for a portion of my bond, right? The general contractor I have also seen charge administration fees, which I guess they can do. Some administration fees, it feels unfair. I've seen some regular contracts that have some outrageous fees. However, I don't know where the line is on what's reasonable and what's not, but they can. So here's what I'm going to do. If I'm issuing this bond down here for this subcontractor, I'm going to say, hey, subcontractor, go talk to the general and ask them how much they're going to charge. How much are they charging for their bond and administration fees? And your bond is going to be 1%. Now you take that information, and is it worth getting that retainage early? It's a business decision you need to make. If you really need those funds, then maybe you want to do it. If you can live without it, then maybe you don't pay the extra fees, and you work with it. Now let's say you subcontract, you're like, that's ridiculous. I'm not paying those extra fees. I'm totally fine. I've got the working capital. I put in enough profit. I'm fine. And let's say the job is done and it's like a year later and you still don't have your retainage. You can file that retainage bond at that time. So you don't have to, like your performance and payment bonds where you have to file it right, before you sign the contract or when you sign the contract. The retainage bond, you can file at any time. So you could file it at the end of the job. You could file it, let's say halfway through the job, you're like, this job is getting wacky and I'm nervous and now I would like those funds. So if, let's say we issued that retainage bond in the middle of the job, the general contractor would release all of the retainage for the contract up to that point. And then for every draw after that, it would be 100% and they would not have that holdback in there. Complicated? You get it?
I can see how it can get complicated. Like you said, just trying to keep track of, because one sub may not want it, another
Right.
may. And so administratively, there is some
It's
finagling
a
that has to
mess.
be done. Hence
Absolutely.
maybe why there's an administrative fee.
Yes. Oh, yeah. Yeah. If the administrative fee is the amount of the retainage, that's unfair. And that I have seen.
Yeah, that's steep. Okay.
Can you say that again?
I have heard that a general contractor charged an administrative fee that equaled the amount of the retainage that was being held.
Yeah.
Which defeats the whole purpose. The whole idea of having a retainage bond is that
Right.
you
And this is
get your
why
retained.
I try to get in early before we issue the bond. I want you, the contractor, to know what this is going to cost you. I mean, I can tell you what I'm going to charge, but I don't know what's going to happen up the line. So you need to do a little bit of research on that. All right. I'm getting I think I talked too much. I'm going to talk really quick about developer bonds. This might not touch you, but these are not capital bonds, right? These are not public works bonds. Here's another opposite for you, right? The capital bonds, the bonds that we post on jobs to the Port of Seattle, the payment comes from the public entity. Whereas the developer has to have the funds. And that makes these developer bonds way more difficult to write. And the reason I'm telling you this is because I have seen contractors being asked by developers to post these bonds, do not post these bonds. This developer bond guarantees that you are going to complete the work on a job, and an offsite improvement developer completion type bonds, even if you don't get paid. Because the developer has to have the funds up front. So if you as the contractor to a developer are being asked to post this kind of bond, absolutely don't do it. And I'm happy to look at the bond form and look at the contract before you do it and let you know I don't even have to be your surety professional. I don't want you to post these bonds if you don't have to.
And Cara,
Yeah,
this is developers like in the private market. It
correct.
seems like that's the difference between
It's all private.
public
Yes.
versus private. When that capital side is public, when you're
Perfect.
talking about these developers, it's in the
Yep.
private market. Okay.
Yep. You got it. All right. I think I've talked for an hour. How are we doing on time? How much time do I have?
You still have another 8 minutes. You're good.
Okay.
Keep it rolling, sister.
Okay. All right. I'm going to pass up this. We all know that. I wanted to go through this because I had a story of a contractor who had some problems here. We talked in level one, we talked about the Miller Act. These are payment bond claims. So this is the visual of how it works for subcontractors on a federal government job. So we have our federal government contractor, right? We have the government, we have our contractor, we have our first tier subcontractor, our first tier supplier. These two can make payment claims on the bond, this bond. On federal Miller Act, federal, if it's a federal job, the second tier subcontractor and the second tier material supplier of this contractor can make a claim if they don't get paid. However, this supplier that's a supplier of a supplier, they can't make a claim. And anything third tier cannot make a claim. And I didn't make a slide for this, but let's pretend like this is not a federal job. This is a state job, okay? For the Little Miller Act, remember those are the Little Miller Acts. For the Little Miller Act, only first tier. So it would only be these two. Can you see my little cursor doing this? Only these first two can make a claim on that bond, according to the Little Miller Act. However, I have a contractor, general contractor, state job. They had a first tier subcontractor, first tier supplier. They are allowed to make claims. My general contractor paid everybody. This contractor did not pay their second tier. So they shouldn't be able to make a claim, right? The Miller Act, the Little Miller Act. However, because the bond form said that it would go down another tier, my general contractor has to pay them even if this sub did not pay them. This is where we need to talk to an attorney. So here is what I suggested to my GC going forward. You need to be able to say yes or no to these next tier contractors. So you as a general contractor, every time you post a bond, you are opening yourself up for liability. And it could be liability you don't even know about. So you need to have some control here, and you need to be able in writing, because remember, if it's not in writing, it didn't happen. Because my general contractor, she said, I told them not to hire that sub, and they hired him anyway. And now they're making a claim when she paid them. So a little horror story. Not trying to freak you out too much. Closing bonds. I think this is important because of what I just said, right? Every bond that is issued on your behalf opens you up for liability. So you want that closed as soon as possible. License bonds are easy. Your license bond probably has an expiration date on it. Your performance and payment bonds, if you've ever read one, there is no expiration date. Only the owner of the job, the obligee, is the only one that can close and exonerate that bond. There is no canceling the bond because there is no cancellation clause. That bond is in force until, let's say, the port says, okay, everything's done, everything's great, and you're done, and the warranty has started because the bond is still on there for the warranty, and then the bond is closed. And you want to make sure that you get that in writing. The horror stories come on the plat bond side because the developers forget to get these exonerated. And then 7 years later, the city comes back and says, oh, we're still under maintenance and you need to come back and fix something. So part of my job is at the end of the job, I'm reaching out to the owners of the job, not the construction owners, not the contractors. I'm reaching out to the owners because I want in writing from them that the job is complete and final payment has been made. And that's when I start the clock for the warranty, if there is one. And that's when I close the bond. Um, and so if I'm coming to you, so I have a hard time with this because the owners, the obligees are like, I'm done. Everything's great. And I never hear back from them. So I might need your help as a contractor to find the right person to get that in writing. And that is for your benefit too. Okay, last slide. This is what I told you guys we were here for, right? How do you lower your rates and how do you increase your program? And it is a lot of what we just talked about. It's the financial statements. If you have internal financial statements, you're probably going to pay more than the contractor who has reviewed or audited financial statements, reviewed financial statements, really, right? If you have higher net worth, debt to equity, some of those other ratios, I didn't go into all of them. If the ratios are a certain level, that will help. Oop, sorry, my God. That will help lower your rate. And the surety companies in the state of Washington have to file their rates with the insurance commissioner. And sometimes it depends on the class of business. So a roofer might have to pay a different premium than a painter, that kind of thing. There might be that. And really, it's almost all the same work for increasing your program. So the quality of the financial statements, the quality of those ratios, and then these are the big ones, completed job size. So if your largest completed job is $1 million, I'm going to have a hard time getting you a $20 million bond. I might get you, if your largest job is $1 million, I might be able to get you $1.5 million. I might even be able to get you $2 million if it's the right job. If it's an owner you've worked with before, it's the same kind of work you always do, it's a simple job, that kind of thing. So the idea for an increased program, yes, do all the financial statement stuff, but also it doesn't have to be bonded. Get some work under your belt that's close to the job size you're looking for. And it doesn't, I know I said this already, but I'm going to say it again, it does not have to be bonded. I'm going to ask for a reference. I might actually call them and make sure you did a good job on your largest completed job. So what I try to do is at the end of every year when I ask for financial statements, I'm going to ask my contractor, what is your largest completed job now? Because when I first started working with you, it might not be the same as it is now. So getting that on the books with your surety company is going to be really important. Okay, the end. I had to get my dog in there because I couldn't get my Venn diagram in there. So here's some more information for you. And again, I'll get this to you guys so you have it. And I know I talked really fast. Does anyone have any questions? Did you take away at least one thing you didn't know before we started?
So Cara, I did post a bunch of links in the chat.
Okay.
The last item that I posted was a list of the Washington State construction CPAs
Oh, cool.
based on the whole state
Awesome.
with some links and stuff in there. So, if you have any questions about any particular CPAs and their competencies, you can always go to the Washington State Board of Accountancy, to check them out a little bit more. But, and Cara, I suspect that a number of these that are on my list are on your
Yes.
list. Guys like Clark Newber and Moss Adams and
Yes.
yeah, some of those guys have a really stellar reputation in construction accounting.
Yes. And if you're looking for an introduction, let me know and I'll see if I can, if I know somebody at the CPA firm and I can make an introduction, I'm happy to do that.
Okay.
Any
Well,
questions?
thank you, Cara.
Okay.
And if you know, if our participants have any questions, please reach out to Cara at her contact information that we posted in the link, or you can reach out to Washington Apex,
Yes.
and we're happy to answer your questions. So, Emily, any last minute thoughts or ideas?
No, I just this was great. I definitely learned a lot. Yeah, just you showing the different kind of accounting methods, and then it's the same company actually, just how you choose your method really
Mhm.
impacts the information that you end up getting.
Mhm.
Um yeah, just so much good stuff. So thank you so
Definitely.
much, Cara. You always put it in like a very, I think, accessible way too. So just appreciate you. And thank you to Apex for getting this all together. We've got one more, I think, one more official one, and I'm going to be bringing my colleagues from badging and our project labor agreement group to talk about some of those things. If you're interested in construction contracting at the port, those are really good things to know about, to be able to consider, and then to account for if you're pursuing a job. So we'll hope to see you next Wednesday. And that's all I've got, Leslie.
1 second.
Okay, we'll leave it to Miriam to close us out.
No, I think like Emily said, this session was super impactful. And even though I didn't sit in on the first one, I think you did a wonderful job of kind of bringing us up to speed and giving us a good overview. Clearly, you could probably talk about this for hours because of the depth that it could go. But I appreciate what you went over. Oh, Abdul has his hand up.
Go ahead.
Yeah, I've got a question for Cara.
Sure.
Well, again, good to see you again, Richard. So, yeah, of course, indeed. So, I have um, I have money set aside. I haven't get any income yet from projects, but I do just spend for expenses, buying this and what have you.
Mhm.
So, we talk about a balance sheet, we talk about income statement, because of financial setup. Where do I put these expenses and where I put this or what do I need to create?
So you're going to start with an opening balance sheet. So this is like what you started the company with. So you said you had some money set aside. So either you're going to put it into the company as you're funding the company, you're giving it to them, or you could be loaning it to the company. If you loan it to the company, keep in mind that there's going to be a liability. And it's going to make their opening balance sheet's not going to be strong anyway. It's going to be after you start making money and keeping money in the company. That's when you're going to start building up that balance sheet. But so you can put it into the company by giving it to the company. So let's say you gave the company $100,000, you would have $100,000 in the cash section, and then you would have $100,000 in your net worth. And then as you start spending money, right, because you're going to have some expenses, those expenses are going to come out of your net worth. And then eventually you're going to start making money and income will come in and it will continue to balance out. Does that
Yeah,
help?
beautiful.
And
So,
then, and if
yeah,
you haven't done a whole lot of work yet, something else to think about is get a really strong resume, because the other thing that the surety company is going to want to see is completed jobs, right? And if you haven't completed any, they're going to you're going to have a problem. But if you can show them that you have experience somewhere else, working for somebody else, list some of the largest jobs you've done outside of this company, that will help improve your program, your surety program as well.
Beautiful, beautiful. Yes.
Thanks for the question.
Again,
okay.
we apologize for taking you guys over time, but again, this topic, you doing it in an hour again was already Herculean. And there's more to cover it. So
Oh, yeah.
be sure to check out in the chat. There are links to the upcoming events, including the one that Emily mentioned. Next week will be the 6th of this training series that has been covered. A lot of great information has been covered during this training series. So if you haven't had the opportunity to participate in them week to week, fear not, we have the information for you. I definitely think it's worthy of any of our businesses to take advantage of and listen to, and even reflect and go back if you did have a
Mhm.
chance to sit in on them to get the information. And then we encourage you to take advantage of not only next week's session, but please come out to the celebration that we're having in December. That's going to be a great opportunity to network not only with the port, but with other companies as well that have been on this journey to get the information, to continue your knowledge base, and to hopefully get some work with the port. That is the goal of why these sessions are taking place. They've got some great projects that are coming up, and we want to make sure that our businesses are ready to be able to get in there and not have the difficulties that Cara has experienced or talked about, or at least be more knowledgeable of it so that if you run across it, you can maneuver it a little bit better. So with that in mind, Leslie, again, thank you for holding us down, providing the minutes and the notes that we have in there, Cara. Thank you again for your
Thank you.
expertise for 2 weeks straight. I hope people will take advantage of the information that you shared and reach out to you since
Of
you
course.
graciously allowed us to
Yes,
do so.
of course.
And Emily, again, we appreciate the partnership with you all. Leslie, is there anything else that I'm missing? If not, we'll shut this down.
Nope, I think that's it. We'll call it a day, and thank you all for attending. See you next time.
Thank
Thank you.
you.
Have a great day, everyone.